The descending triangle is the bearish mirror of the ascending one, and it tells a clear story of pressure building to the downside. A flat floor of support tested again and again, with a series of lower highs pressing down on it. Sellers are getting more aggressive while buyers defend one fixed price. Here's how to read it and trade the breakdown the right way. Two boundaries define it. A flat horizontal support, the same floor where buyers keep stepping in to defend one price. And above it, a falling trend line of lower highs as sellers offer stock at cheaper and cheaper levels. As those lower highs press down toward the flat floor, price gets squeezed into the apex. The story is the opposite of the ascending triangle. Buyers hold a static line while sellers grow more aggressive. So the fixed demand at support tends to get absorbed, and the resolution is usually downward through the floor. The lower highs are the tell, just as rising lows are in the bullish version. Each one shows supply hitting the market earlier and earlier, less and less willing to wait for a good price. That's distribution in plain sight, sellers leaning on the floor, and it's why the descending triangle tends to break in the direction of those lower highs to the downside. The trade is precise and mirrors the ascending version. You enter short on the close below the flat support, ideally on a volume surge confirming the floor has finally cracked. Your stop goes above the most recent lower high. That's the tightest logical invalidation, because back above it, the breakdown story is broken. Your target is a measured move. Take the height of the triangle at its widest on the left and project it down from the breakdown. And like all breakouts, a retest of the broken support as new resistance often offers a cleaner second entry. Defined risk at the last lower high, a measured target below the floor. The trap is symmetry with the bullish version, shorting inside the triangle before the floor breaks, assuming it must. It usually does, but support can hold one more time and bounce hard, or the pattern can break up against expectations. Wait for the close below the flat support. Anticipating the break is guessing. Trading the confirmed break is a plan with a defined stop. On a real chart, look for a flat floor being tested repeatedly while the highs above it step steadily lower. Each defended test of the floor looks bullish in isolation, but the falling highs reveal the real pressure. When price finally closes below that floor on volume, the long holders who trusted support are trapped, and their stops can accelerate the move. That's the breakdown you're positioning for. Where it fits, the descending triangle is a short side trigger with structure already built in. The lower highs are the price action. The flat floor is the key level. Add weak momentum and a breakdown on volume, and you've stacked the method on the short side. Because shorting carries extra risk, you want all four signals firmly in agreement before you act. So, a flat support, lower highs pressing down into it, and you enter short on the close below the floor, stop above the last lower high, target the triangle's height. Read the pressure, wait for the release. Subscribe for the full method and trade your own plan. Education, not financial advice.